All right, take a breath and lean in for a minute because the background noise of your evening just got a lot less important. While everyone's arguing about playoff stats and celebrity nonsense, a much bigger drama is quietly loading backstage in Washington. And no, this isn't the usual political soap opera where everyone yells, storms out, and then comes back after the commercials. This feels different, heavier, like the kind of scene where the music changes, and you realize the plot just took a hard left turn. Here's the situation. We're staring at the very real possibility of a US government shutdown in a matter of days, and the tone coming out of DC isn't, let's make a deal, it's brace for impact. The latest political messaging wasn't coded, polite, or open to interpretation. It was blunt, no agreement, no funding, and no backing down. That kind of language doesn't calm markets, it freezes them. Now I know what some of you are thinking. We've been here before. Government shutdowns are political theater. National parks close, federal workers grumble, and then someone caves. Fair. Historically, that's been the script. But this time, the economic backdrop is a lot more fragile. Inflation has been stubborn, debt levels are towering, global tensions are simmering, and financial systems are already running hot. A shutdown now doesn't land on a calm lake. It lands in choppy water. Here's where it gets technical. But stick with me because this part matters. Modern financial markets don't run on vibes. They run on data. Massive institutions, hedge funds, pension systems, central banks. They all rely on a steady stream of government statistics to make decisions. Inflation reports, jobs numbers, consumer spending data. These are the instruments on the dashboard of the global economy. If the government shuts down, a lot of those data pipelines slow down or stop. Agencies that compile and release key economic reports scale back or pause operations. That means delayed or missing numbers. And when the numbers disappear, uncertainty spikes. Imagine flying a plane through turbulence and suddenly losing half your instruments. You can still fly, but you're doing it with less visibility and every move feels riskier. Now put yourself in the seat of the Federal Reserve. You're already balancing inflation concerns, growth worries, and financial stability. Then suddenly, some of your most important real-time indicators go dark or get delayed. Do you tighten policy without clear data? That's dangerous. Do you ease aggressively? That risks fueling inflation. So what happens? Central banks tend to lean towards stability and liquidity when uncertainty jumps. They don't like surprises, and they really don't like financial seizures. Markets know this. Big money doesn't wait for official press conferences. It tries to anticipate reactions. When traders think central banks might tilt toward caution and liquidity, they start repositioning early. That can mean moves into assets seen as hedges against currency weakness or financial stress, things like precious metals or other perceived stores of value. Whether those moves are justified or overdone is another debate, but the behavior itself follows a familiar pattern. Uncertainty rises, defensive trades pick up. Timing makes this even more delicate. Parts of the financial system have already shown signs of strain over the past year. Funding markets tightening here and there, liquidity pockets thinning out. Nothing catastrophic on its own, but enough to remind everyone that the system works best when confidence is steady and information flows smoothly. A shutdown that muddies the data, waters doesn't cause problems by itself, but it can amplify nerves that are already there. And then there's the political layer, which is adding gasoline to an already flickering fire. Budget fights are rarely just about numbers. They're about leverage, headlines, and sometimes personal grudges dressed up as policy disagreements. When emotions harden, compromise becomes politically expensive. No one wants to be seen as the one who blinked first. On top of that, the national mood has been tense. Across the country, people are already on edge about the cost of living, public safety, and trust in institutions. In that kind of atmosphere, any high-profile incident involving federal authorities can pour fuel on public anger. Protests can grow quickly, narratives can harden overnight, and political leaders feel pressure from their base not to appear weak or conciliatory. When the street temperature rises, the temperature in Congress usually rises with it. That's the part that makes this budget standoff more than a routine fiscal squabble. Lawmakers aren't negotiating in a vacuum. They're negotiating under a spotlight, with activist groups, social media, and 24-hour news cycles judging every move. Taking a deal can look like betrayal, holding the line can look like strength. The incentives shift away from quiet compromise and toward public confrontation. So you end up with two high-stakes systems, finance and politics, feeding into each other. Markets get nervous about a shutdown and possible policy responses. Politicians get more rigid because the political cost of backing down rises. That rigidity makes a shutdown more likely, which makes markets more nervous. It's not a conspiracy, it's a feedback loop. Does that mean total collapse is guaranteed? No. Financial systems are more resilient than the internet gives them credit for. And governments have a long history of pulling back from the edge at the last minute. But it does mean the margin for error is thinner than usual. When data flow slows, when rhetoric hardens, and when public trust is shaky, even routine disruptions feel bigger. For everyday people, the practical takeaway isn't to panic. It's to be aware. Volatility can pick up. Headlines can get louder. Asset prices can swing more than usual as investors try to read tea leaves with fewer official numbers in hand. That's uncomfortable, but it's not the same as the system switching off overnight. Still, the clock is ticking toward a funding deadline, and the tone out of Washington suggests neither side wants to be the first to flinch. Financial players are adjusting in advance. Policymakers are digging in, and the broader public is watching a mix of economic anxiety and social tension play out at the same time. It's a complicated, combustible mix. So, yeah, this isn't just another sleepy weekend political story. It's one of those moments where economics, politics, and public emotion all intersect. And when that happens, things can move fast. Whether cooler heads prevail or we ride this all the way into a shutdown will shape not just government operations, but market psychology in the weeks ahead. Keep your seatbelt fastened. Not because the plane is definitely going down, but because we have to hit a patch of air where pretending everything is smooth would be the real mistake. Let us pick up the thread where politics stops being a budget spreadsheet and starts looking like a pressure cooker with a broken valve. The fight in Washington has moved beyond line items and into something far more combustible, moral positioning. Lawmakers on one side are signaling they support any funding package tied to controversial federal enforcement actions. Lawmakers on the other side are just as dug in, warning that pulling funding would be seen as abandoning law and order. When both sides believe compromise equals betrayal, the math stops working. That's how stalemates form, not the theatrical kind where everyone secretly plans a last-minute handshake, but the rigid kind where backing down feels career-ending. In that environment, a shutdown shifts from possible to probable, not because no one understands the economic consequences, but because the political incentives now outweigh the practical ones. Emotion has entered the negotiating room, and once that happens, spreadsheets lose their superpowers. Now layer that onto financial markets, which, for all their algorithms and PhDs, are still driven by one ancient force: confidence. Markets can tolerate bad news. They can price in recessions, wars, elections, even the occasional meme stock uprising. What they hate is uncertainty with no timeline and no reliable data. A shutdown that disrupts the regular flow of economic reports adds exactly that. Investors rely on government statistics the way pilots rely on instruments, inflation readings, employment data, consumer spending numbers. These aren't trivia. They're inputs into trillions of dollars of decisions. If report schedules get delayed or data collection is disrupted, markets don't just shrug. They widen their margin of error. And wider margins mean more volatility. At the same time, political and social tensions amplify the mood. When headlines mix fiscal gridlock with images of protests or unrest, the narrative shifts from temporary dysfunction to system stress. Well, whether that perception is fully justified or emotionally exaggerated almost doesn't matter in the short term. Markets trade on perception first and verification later. So where does money go when nerves rise? Historically, toward assets perceived as defensive, liquid, and outside direct political control. That is why you often see renewed interest in things like gold during periods of institutional distrust or policy uncertainty. It's not magic, it's psychology. Gold doesn't file earnings reports, miss guidance, or hold press conferences. For some investors, that simplicity is comforting when everything else feels complicated. Silver tends to get swept into that conversation too, though it behaves more erratically because it straddles two worlds: precious metal and industrial input. In anxious environments, price moves in these markets can accelerate quickly, especially if speculative money piles in alongside genuine hedging demand. Momentum feeds on itself. Rising prices attract attention attracts buyers, and buyers push prices further, at least for a while. But here's where we add a dose of professional caution. Rapid price acceleration doesn't automatically mean a straight line higher forever. Markets move in waves, and sharp rallies often come with sharp pullbacks. Even in genuine bull markets, corrections are normal. The idea that any asset only goes up in a crisis is emotionally appealing and historically unreliable. That said, speed does matter. Traders watch not just price levels, but the pace of change. When moves that used to take months start happening in days or weeks, it signals a shift in positioning and urgency. It tells you the market isn't just rebalancing, it's reacting. Whether that reaction is sustainable depends on underlying liquidity and broader risk appetite. And that brings us to the plumbing, the part of the system most people never see until something breaks. Behind every stock rally and every hedge fund trade is short-term funding. Large investors borrow cash overnight, pledge high-quality collateral like U.S. Treasuries, and roll that borrowing continuously. As long as money markets function smoothly, leverage hums along quietly in the background. One of the key reference points in that world is SOFR, the Secured Overnight Financing Rate. Think of it as the going rate for borrowing cash overnight against Treasury collateral. When SOFR behaves, it suggests the gears of the financial system are turning smoothly. When it jumps sharply relative to other policy rates, it can signal rising demand for cash or reluctance to lend. Another important benchmark is the interest the Federal Reserve pays banks on reserves held at the Fed. In stable conditions, these rates tend to move in close alignment. If they diverge meaningfully, analysts start asking why. Is there a temporary technical imbalance, quarter-end balance sheet constraints, or is there deeper stress in funding markets? It's crucial not to jump straight to apocalypse. Short-term rate spreads can widen for mundane reasons and then normalize. But sustained stress in funding markets does get attention because leverage depends on cheap, reliable short-term borrowing. If that borrowing becomes expensive or scarce, leveraged investors may reduce positions. And when many players try to de-risk at once, asset prices can fall quickly. Not necessarily because companies are suddenly worse, but because balance sheets are tightening. This is how liquidity events happen. They're less about dramatic headlines and more about the quiet mechanics of financing. A fund gets a higher borrowing cost, it trims positions, prices dip, risk models flash yellow, more trimming follows. The feedback loop runs in reverse. It asks the financial equivalent of everyone heading for the exit at the same time after someone smells smoke. Now combine that potential funding stress with a noisy political backdrop and patchy economic data, and you have a recipe for heightened market sensitivity. Every rumor feels bigger. Every data point, when it does arrive, carries more weight. Price swings become sharper because conviction is lower and hedging demand is higher. Does that automatically mean a stock market crash is imminent? No. Financial systems have buffers, central banks have tools, and policymakers, despite appearances, generally prefer stability to chaos. But it does mean the environment is fragile. Fragile systems don't need huge shocks, they just need the wrong combination of smaller ones at the wrong time. For long-term investors, the lesson isn't to make dramatic all-in bets based on viral narratives. It's to understand that volatility can rise when politics, funding markets, and public sentiment all wobble together. Diversification, liquidity, and risk management stop being boring textbook concepts and start looking like very practical survival gear. So yes, the temperature is rising. Washington is gridlocked, market nerves are visible, and certain assets are moving fast enough to make even seasoned traders raise an eyebrow. But panic is not a strategy. Awareness is. Watch the data flow, watch funding conditions, and watch how policymakers respond when stress shows up. Because in the end, markets don't just move on fear. They move on how institutions react to fear, and that story is still being written. Before we talk about price targets and Monday morning fireworks, let's zoom out for a second and look at how market crashes actually unfold. They rarely start because everyone suddenly agrees the world is ending. They start because traders run out of liquidity. Leverage gets expensive, funding tightens, and positions that looked comfortable on Friday become impossible to hold by Tuesday. We saw that dynamic in 2008. We saw a version of it again in early 2020. The trigger headlines differ, but the mechanism is familiar. When cash becomes king, everything else gets sold. In a true liquidity squeeze, correlation goes to 1. Stocks drop, corporate bonds drop, crypto drops. Even assets people swore were uncorrelated suddenly move in the same direction because what investors really need isn't a better return. It is cash to meet margin calls and redemptions. Anything with counterparty risk, anything that depends on someone else's balance sheet holding together, gets questioned. There is, however, a long-standing belief in markets that certain tangible assets behave differently in moments of deep financial distrust. Precious metals sit in that category for many investors because they don't represent a promise from a bank or government. A gold coin doesn't depend on a quarterly earnings report or a central bank press conference. That perception, whether you agree with it or not, is powerful during periods when institutional trust wobbles. And what's interesting right now is the narrative forming around a possible divergence. Typically, in the first phase of a sharp market sell-off, even defensive assets can dip as investors scramble for cash. Later, if policy responses kick in and confidence in paper assets erodes, hard assets may recover faster. Some traders are betting that this second phase could arrive quickly if funding stress and political dysfunction collide. A key piece of that story revolves around short-term funding markets. When rates like SOFR start moving higher relative to other policy benchmarks, professionals pay attention. It can signal that cash is getting more expensive in the private market, even if official policy rates haven't changed. That gap doesn't automatically mean crisis, but if it persists, it can pressure leverage players who rely on cheap overnight borrowing. And that's where equity markets become vulnerable. A lot of modern portfolio strategies are built on the assumption that short-term funding will remain smooth and predictable. If borrowing costs jump or lenders grow cautious, funds may have to trim positions. They don't sell because they hate the companies. They sell because their financing math changed. It's plumbing, not philosophy. Now add a tense political backdrop and the possibility of a government shutdown disrupting economic data releases. And you get a market environment primed for sharp reactions. Algorithms respond to volatility, spreads, and momentum faster than any human can. When multiple stress signals light up at once, those systems can amplify moves in both directions. That brings us to the near term, specifically how markets might behave at the start of a week loaded with uncertainty. After a weekend full of intense headlines, global markets often open with gaps as traders adjust positions all at once. Asian trading sessions can set the tone before U.S. markets even open, especially in assets that trade nearly around the clock, like precious metals. It wouldn't be surprising to see elevated volatility right out of the gate. Orders that built up while markets were closed get executed quickly, and price discovery can be messy. At the same time, measures of expected volatility, like the VIX, may react strongly if investors decide the path ahead just got harder to predict. When volatility indicators jump, many systematic strategies automatically reduce equity exposure. That can put early pressure on stock indexes. But here is the part that seasoned professionals always emphasize. The first move isn't always the lasting move. Sharp drops at the open can be followed by rebounds as longer-term buyers step in. Likewise, early rallies in defensive assets can fade if broader markets stabilize. Fast markets are emotional markets, and emotions overshoot. For anyone watching precious metals, it's important to separate long-term positioning from short-term trading noise. Rapid price swings, up or down, are common when a narrative catches fire. Some participants are hedging genuine risks, others are chasing momentum. Those are very different motivations, and when momentum traders rush in, pullbacks can be just as dramatic as rallies. The bigger picture question is whether stress in funding markets and political dysfunction meaningfully erode trust in traditional financial assets. If that happens, allocations to tangible stores of value could rise over time. But that's a process, not a single trading session. Even in periods of strong demand for metals, prices don't move in straight lines. Corrections are part of the journey, not proof the thesis is broken. For equity investors, the focus should be on liquidity and risk tolerance. Can you handle larger daily swings? Are you overexposed to highly leveraged or speculative corners of the market? Those questions matter more than trying to predict the exact level of any index on any given day. When funding conditions tighten, the most leveraged areas tend to feel it first. For metals investors, the discipline is different, but just as important. Know whether you're holding for long-term diversification or trying to trade every fluctuation. The former requires patience and secure storage. The latter requires nerves of steel and an acceptance that volatility cuts both ways. Mixing the two mindsets usually ends badly. As the week unfolds, headlines about budget negotiations, social tensions, and central bank signals will compete for attention. Markets will swing as participants constantly update their expectations. Some days will feel like panic, others like relief rallies. That doesn't necessarily mean the system is collapsing. It means uncertainty is being priced in real time. The real story to watch is how institutions respond. Do funding pressures ease after a few tense sessions, or do they persist? Do policymakers move quickly to reassure markets, or does political gridlock drag on? Do investors step in to buy dips in risk assets, or do they keep reducing exposure? Those behaviors will tell you more than any single viral prediction. So yes, buckle up for a bumpy stretch. Liquidity, confidence, and politics are all interacting at once, and that combination rarely produces calm charts. But remember, volatility is a feature of stressed markets, not proof of the end of the financial world. Smart participants focus on resilience, diversified exposures, manageable leverage, and enough liquidity to avoid being forced sellers. Because in the end, markets don't just reward boldness, they reward staying power.